GDP is on boom. Now, for example, tomorrow's data is expected to be 225k. So US generates on an average 200,000 jobs every month, 2 lakh jobs every month. Tomorrow they are expected to release this data and they say that we might have 225k more jobs in the month of June. Now, if this number comes out to be significantly higher than 225k, it means US GDP is on rise and it means the global GDP is also on rise. So what we have discussed is, let us go through this PPT for a while and you will be able to understand what I'm saying. So US non-farm payrolls data, when for example this number comes out to be 339k, wherein the forecasted number was 180k and the previous number was 294k, this tells me that the US is growing great, the US is doing great, and they will be generating more GDP, they will be causing more inflation, and the money will start flowing out of the country, which means it is good for the global economy. It is good for the risky assets, it is good for the equity market, it is good for the broader riskier assets. Anything which is good for the US economy is good for the risky assets. Anything which is not good for the broader economy, whether US or the world, is broadly good for safe haven assets. So whenever you see that US Fed holds rates steady but sees 2 small hikes, it means this is a contractionary monetary policy. This is likely to bring the gold prices down, and also it is likely to bring the equity prices down temporarily. So anything which is expansionary in nature decreases the value of gold, and hence the equity and gold might go up depending upon the scenario. Anything that decreases the money supply into the system increases the value of gold, increases the value of dollar. And let me give you a very, very important statement, that when dollar increases, chances are nothing else in the world increases. Anything that increases the money supply will bring the price of the gold down. If price of the dollar down, if the price of the dollar decreases, if the dollar depreciates, then gold appreciates, equity markets might appreciate depending upon the situation. If anything is contractionary or anything that reduces the money supply from the system, the dollar increases. And always remember, when dollar increases, nothing else increases. I'm talking about the dollar index. When dollar index increases, USD INR also increases. When USD INR increases, as I discussed earlier, the Nifty is not going to perform. Now, what is the driver of this central bank monetary policy? The driver of this central bank monetary policy is the inflation. The last topic that we are discussing, and then I'll take up all the questions. So this entire story starts from inflation. Now, I am not just discussing one of the most important topics. This would also give you the crux of the entire session. Where does this entire story starts? The entire story starts with inflation. Inflation for the central bank. Inflation for the central bank is like a rat in your house. Once you see a rat in your house, when we talk about India, the comfortable level of inflation is anywhere between 2% to 6%. 4% plus minus 2%, which is 2% to 6%, is the comfortable inflation level for India. Whenever the inflation goes beyond this range, then RBI generally has to act, or generally acts. Maybe they may not act for a month or a couple of months, but eventually they will be acting, unless until this inflation is primarily because of, let's say, it is not a core inflation, it is, let's say, a skewflation. Like for example, these days tomato prices are significantly high, so this may cause temporary rise in inflation. That is not important for RBI. Let us say the cement prices, steel prices, iron prices, crude oil prices, gas prices, when they increase, they cause heavy inflation, which is core inflation. So when inflation increases heavily, central bank increases the rates. When central bank increases the rates, this causes dollar to appreciate. When dollar appreciates, all other things fall down, they nosedive. So inflation goes up, interest rates go up. Interest rates go up, equity market, gold market, all other markets, they come down. Even the bond prices fall. Inflation goes down, interest rates go down. Interest rates go down, dollar depreciates because there is more money into the system. Dollar depreciates. Dollar depreciates, equity prices go up, gold prices go up, and also when the interest rates go down, then the bond prices also go up. Remember that sequence: first bond, second equity, third gold. So the entire driver of the market is inflation. Inflation changes, central bank acts, interest rates change. Interest rates change, the price of the bonds, the bond prices goes down or up depending upon where the interest rates are going up. Interest rates increase, bond prices come down. Interest rates increase, first the money starts flowing out of the bond market, then it flows out of the gold market, then it flows out of the equity market, the sequence. Interest rates start coming down, gold shoots up, equity market shoots up, bond prices go up. Last thing, I would like to discuss this case with you. What happened during the entire case? This is the practical thing of what we have discussed. Now, the background of this Silicon Valley Bank or some other banks which went bankrupt during this period starts with, for example, I am trying to open a website called tradingeconomics.com. On tradingeconomics.com, you would notice, or you all are aware, while the time we are opening I'm opening the website, you all are aware that whenever US prints money the way it did in COVID-19, the inflation increases. So US printed approximately $4.8 trillion during COVID-19, inflation increased. This kind of inflation US was ready to deal with. But then happened Russia-Ukraine war in the month of February 2022. Then came supply side inflation from natural gas, crude oil, nickel, copper, all these products. Because of which the inflation went haywire. The US, rather look at the inflationary situation in US or UK, for example. The situation is so bad. This is the inflation for the last 1 year in US. Have a look at the 5-year. This is where we were standing. Have a look at 10-year. This is where we were standing. Have a look at 25-year. Only around a couple of months ago, this is where we were standing. This is US inflation. If we look at the UK's inflation, you'll be surprised to know for the last 25 years, for the last maximum chart that you can see, UK has witnessed significantly high inflation. This is why the UK and the US central bank, they started printing a lot of money. This is why they started increasing the rates heavily, and this is what made the bond prices fall. The Silicon Valley Bank, the Credit Suisse, all these banks, they were holding the US bonds, the dollar denominated bonds. When the interest rates went up and the bond prices went down, the assets value of Silicon Valley Bank, Credit Suisse, all these banks went down heavily, and they eventually went bankrupt because the equity value, because the assets value became lower than the liabilities, so the equities became negative. So the companies went bankrupt. Let me recap this entire thing for you, and I'll open the floor for questions. So the entire story starts with inflation. If inflation goes up, interest rates go up. As long as inflation is going up and the interest rates are not going up, the gold is the biggest beneficiary, which means anything that causes inflation and we are not increasing the rates, the gold price is something that the gold is the asset class where we should be parking our money. After the gold, the equity markets will also start increasing because inflation means there is more money flow into the system, and the interest rates are low, so the borrowing costs for the companies are also low, and eventually then the bond prices also start moving. But as soon as central bank says that I'm going to increase the rates, gold is the biggest loser here. The gold prices come down, and then the equity markets come down if the interest rates start increasing. Which means the crux of the story is, as long as inflation is increasing but the interest rates are not increasing, we need to park our money on gold. Gold will be the biggest beneficiary here. Once gold has moved up, the money would start flowing into the equity market will also start going up. Whenever central bank thinks about raising the interest rates, the bond prices will collapse, the equity will then collapse, and the gold will be the biggest loser there. So this is how the broader financial markets move. And how does or why does the central bank act? It depends upon how much the inflation is there in their country. What is the cause of inflation? There are certain data points. For example, one of them I mentioned is the US non-farm payrolls. This is also called the mother of all data releases. So if the US non-farm payrolls increase, it means that more people are getting the job, which means this will give rise to inflation later. So this is a leading indicator. Inflation is a leading indicator of increasing prices in gold and equities. Last but not the least, whenever there is a crisis-like situation and whenever there is a war-like situation, please make sure you add gold in your portfolio. This is going to be the biggest beneficiary. And whenever there will be a war in Middle East, then crude oil is going to be the biggest beneficiary, and all the companies which are the consumers of crude oil are going to be the biggest losers. With these words, I conclude. If you have any question for me, please feel free to ask.